For decades, the financial controller has operated under a strict historical mandate: manage the daily accounting, ensure GAAP compliance, and generate static reports. That model works reliably for a single entity startup, but under the pressure of enterprise scaling, it fails completely. 3 specific triggers force this collapse. Expanding into multiple locations creates immediate multi-entity complexity. New revenue streams require specialized revenue recognition tracking. And finally, external regulators now demand strict adherence to emerging environmental, social, and governance criteria. As the data volume multiplies, the finance department becomes purely reactive. They spend their time manually consolidating spreadsheets and reconciling errors. Because every purchase and strategic plan requires their review, finance becomes an operational bottleneck, slowing down execution across every other department in the company. To survive enterprise scaling, the finance function must split into 2 distinct models of operation. Pushing massive transactional volume through a legacy accounting team leads to systemic stagnation. Without re-engineering the actual structure of the finance function, the organization loses enterprise value to simple operational friction. The modern C-suite requires predictive analysis to allocate capital. They cannot steer a scaling company using backward-looking reporting. This 3D organizational chart illustrates the necessary division of labor. The traditional role is splitting into 2 distinct hemispheres. The operational controller handles internal factors, clears transactions, and acts as custodian of historical numbers. The strategic controller analyzes external markets, executes forward-looking modeling, and acts as a business partner. In a high-growth environment, a single human executive cannot execute both opposing mindsets. One requires extreme attention to micro-transactional accuracy, while the other requires macro-level strategic risk assessment. Forcing an executive capable of strategic analysis to spend their week manually calculating sales commissions or reconciling month-end accounts wastes their value to the enterprise. It traps talent in routine data entry, which leads directly to executive burnout. Building a strategic finance function requires a total offloading of the transactional baseline. Modern companies achieve this by utilizing finance as a service, or FaaS. By integrating specialized service providers with AI data engines, scaling companies can automate transactional bookkeeping, accounts receivable, accounts payable, and basic regulatory compliance reporting. This operational transition reveals a structural trade-off. To obtain strategic influence over the company's trajectory, the finance team must release its grip on the minute-to-minute tactical processing of the ledger. Human data processors require days to consolidate reports and verify inputs. Automated ledgers ingest, categorize, and reconcile data in real time. By offloading the operational baseline, the strategic controller recovers their cognitive bandwidth. They stop assembling the data and start analyzing it. Automating the baseline is a direct purchase of the bandwidth required to execute predictive analytics. Historically, operational departments interacted with finance through a strictly linear, highly siloed chain of command. This flowchart maps traditional mechanics. A department passes a spending request to finance for isolated review. This single handover creates a 7-day bottleneck, generating massive friction. Modern scaling requires a concurrent, embedded workflow. Instead of a gatekeeper, the finance partner is embedded in planning. Under a collaborative approval process, joint evaluation replaces isolated review. The department provides the operational context, and the strategic controller provides the financial modeling to make the request viable. To execute this without confusion, the entire company must operate from a single source of truth. Cloud-based planning software eliminates the version control errors that occur when different departments maintain conflicting spreadsheets. We can measure the exact impact of this embedded model on procurement. By evaluating vendor contracts jointly upfront, complex procurement cycle times drop significantly, often clearing approvals in a matter of days rather than weeks. Embedding finance replaces post-facto risk mitigation with proactive growth acceleration. Freed from manual data entry, the strategic controller tracks dynamic, real-time operational metrics rather than static historical reports. This unified KPI architecture bridges financial ledgers and daily operations, providing real-time visibility. They monitor operating cash flow to test core viability. Next, the debt-to-equity ratio determines how sustainably expansion is funded by comparing liabilities to equity. Finally, they track the payment error rate. A spiking payment error rate acts as a direct proxy for systemic operational friction. It proves quantitatively that manual sign-offs and keying errors are damaging the supply chain, building the case for automated accounts payable software. Finally, the controller tracks forecast accuracy and time to close. High forecast accuracy and a compressed monthly close cycle serve as the final metrics for evaluating the success of cross-departmental collaboration. Real-time KPI tracking provides the visibility necessary to steer a large-scale enterprise. Without it, the C-suite relies on intuition rather than data. Standard accounting metrics only map the internal health of the business. The modern controller's purview must extend outward to manage massive external regulatory pressures. ESG reporting represents a massive new data architecture. The controller must now verify and report non-financial data with the same rigorous exactitude applied to a balance sheet. As the business scales internationally, maintaining compliance requires navigating diverse, highly fragmented regulatory markets, each with distinct labor, tax, and reporting standards. To manage this, controllers deploy a globally local operating model. They centralize the core compliance tracking at headquarters, while relying on localized software and in-country partners to manage specific regional risks. By successfully translating these complex external liabilities into quantifiable financial strategies, the strategic controller evolves into an indispensable value articulator for the board. The traditional model collapses because single executive oversight cannot keep pace with the overlapping complexities of global regulation, ESG data, and multi-entity accounting. This blueprint maps the required solution. A solid automated ledger sits at the base, handling the operational transactions. This feeds verified data up to the strategic controller, who acts as the bridge, delivering predictive analysis directly to the CFO. The mandate for scaling companies is clear: audit into the daily workflow of the business. The strategic controller sits at the center of this architecture. They are the analytical link translating daily operational execution into macro-level corporate strategy. In modern business operations, manual reporting yields stagnation. High-speed data processing and cross-functional